Now to the results of CNBC's quarterly Delivering Alpha stock survey. 77% of the market participants surveyed said they expect the other 493 S&P stocks to do better than the Magnificent Seven stocks. Joining us now in the markets, Michael Zinn, UBS Wealth Management Managing Director and Senior Portfolio Manager. Michael, great to have you with us. I think we have your audio, but we're going to proceed. There you go. Okay. In 2025, it seems like you're a little bit cautious. Why?
Well, I mean, I'm a little cautious just because I think there's been a little bit of a hidden sell-off here that the indexes aren't really revealing. I mean, the AI winners, the big cap name you just mentioned, have been just a great success in 24. But beneath the surface, the average stock is kind of languishing a little bit. Expectations are high for earnings season. We're priced at about 22, 23 times forward earnings, so we're really going to have to deliver. We're betting on the Fed to ease, but we've had a little bit of an inflation monkey wrench thrown in there. So, that kind of risk could also hamper the tariff agenda, which then hampers the tax cutting agenda. So there are risks out there, but there are benefits too, or there are good things happening, and the economy is growing pretty well. We're expecting the AI trend to continue. So it's not all bad, but I just think it's important to recognize how narrow the breadth of this market has been. I mean, we've been making basically new highs on the S&P. And we're making new lows for the year as far as market breadth. The average stock is well below its 50-day moving average. So when you've looked at that setup in the past where you're making new highs in the market but new lows in market breadth, it's not uncommon for little pullbacks to follow. And the Santa Claus rally may be alive and well. We'll see, or it could be tough sledding. But, it's a sleepy time of year. The institutions aren't really trading. It's a little bit more retail driven. So what happens at the end of the year is not necessarily an indicator for how January and February go. So we're still constructive on next year, but I would say we are a little bit more encouraging patience and to see how the first month or so plays out before diving completely back into the pool.
Going back to the idea of market concentration, Michael, so many people have cited that as, problematic for the advance of the market. And Goldman Sachs had a really interesting note out, I think, a month or two ago about market concentration being in the 93rd percentile. I mean, it just goes to show the power of the Mag 7 or the performance of the entire index. It's been that way for a while. So why would that break now? And why is that such a bad thing, given so much money is going overall to indexing and ETFs, and those are the biggest weights? So it's sort of like a cycle here where money keeps funneling into ETFs, and those are most heavily weighted toward these seven stocks anyway.
Absolutely. I mean, it really has been the trend for a while, and there's no real indication that trend is changing. I mean, I really kind of think of tech as an invasive species, and the rest of the sectors in the market are kind of its addressable market to gobble up. And I think that the danger is just when you look at the earnings expectations that are priced in for these companies now, you are really at massive valuations and massive earning expectations. So, if these companies don't substantially beat and raise, for the first quarter, I think you've got this possibility of more severe pullbacks in those names. And I think, the positive silver lining is if you look even within tech and you look at some of the chip names, for example, that are not perceived to be AI winners, there may be some value there, So it may just be time for a little bit of a broadening to take a look at some of the kind of relative losers of 24 and look and see if some of those names are bottoming instead of just continuing to pile everything into Mag 7 and Mag 7 related. That Mag 7 trend is still super strong. There's no real indication that it's breaking, but as we come into earnings season, and we that's accompanied with the inflation report around the same time, we should just realize that we're priced with a lot of optimism here.
Right. It's interesting you mentioned the semiconductor stocks because I feel like that is one sector where you are seeing almost the most dispersion because the losers
Yeah.
in this sector, they're most exposed to end markets like auto, which has had some problems,
Yeah.
to industrial, which has had some problems. And some of them are just structurally not flawed, but troubled companies. Is that
Yeah.
where you see value to rotate from a winner like an NVIDIA or Broadcom to go into some of these underperformers? Because some of these underperformers are just facing even some secular issues like PC demand being low.
Yeah, PC demand, auto demand, some of these more traditional staid industries, which tend to grow, but they're not growing exponentially. They're growing in the 2, 3, 4% range. But if you look at a value comparison between the AI winners in tech and semis and the AI, non winners, that value differential is just huge. And technically, I think you are seeing some nascent signs of bottoming in those names. And some of them are really good companies that really print consistently good earnings. They're just not perceived to be AI winners. So yeah, I think that's an interesting area of the market. UBS has put out some really neat research, kind of highlighting some of those companies this year, and I think that's one area to look again, just trying to kind of broaden the portfolio a little bit, beyond the usual suspects.